Well, good afternoon, good evening, or good morning, depending where you are. My name is Steve Hill. I'm CEO of AIQ Systems. Today, we're going to be talking for 45 minutes about market breadth and what works. Before we get started, if you could just type a Y in the chat if you can hear me okay and see my screen. Great, thanks, Gerald. Right, so within TradingExpert Pro, we have the unique market timing module that uses our expert system. And within that module, of course, we also accumulate the breadth data off of the New York Stock Exchange. We do also, by the way, have breadth data off of the NASDAQ, but primarily we'll be utilizing breadth data off of the New York Stock Exchange and its relationship to the Dow Jones Industrial Average to get some insight into the breadth indicators that are out there, both what are the indicators that are in within AIQ, but also a couple of other indicators that are not in AIQ, and also programmed one of those within our expert design studio. For ease of use, since I'm going to be switching between PowerPoint and the charting area, I'll keep the PowerPoint presentation within the app rather than on full screen. So first off, I wanted to start with two indicators, the advanced decline line and the advanced decline indicator. Let's just have a review of those two indicators and we'll see which of these seem to work best as a tool for defining when market's likely to change direction. So the classic advanced decline indicator, the advanced decline line, very simple. The difference between the advances for the day and the decliners for the day and sum to the previous day's total. So, one's taken from the other and then it's added to whatever the previous day's total is. So generally very well-known indicator. It does tend to sort of march in time with the market quite a bit. And the thing to look for in the advanced decline line is this break, basically a difference in direction of the advanced decline line from the price action of the market itself. In this case, again, we're using the Dow Jones Industrial Average. So that's the basic is advanced decline line. We're going to look at charts of these two indicators, advanced decline indicator. So this takes it to the next step. It exponentially weights the average of the net advancing versus declining issues. And in this case, the indicator direction of the trend is important. And often when you see the indicators increasing, and that means, of course, advances are outweighing decliners. And of course, when it's decreasing, the reverse is happening. And the final point in here, the indicator is very similar to the advanced decline line, but notice that this tends to signal a move a little earlier than the advanced decline line itself. So we'll look at these first two indicators, and then we'll move down to the next pair and just see what it is that happens when we have these on a chart. So we'll switch to our classic Dow Jones Industrial Average chart, and we'll put underneath the chart the two indicators that we just looked at within that PowerPoint, which is the advanced decline indicator and the advanced decline line. So down the bottom here, this is the advanced decline line itself, and this is the advanced decline indicator. The first thing you might notice, and I found this was very true in that description when it talked about the advanced decline indicator, because it uses some smoothing and some averaging, we do tend to get a little bit of an earlier signal using this particular tool versus the AD line, which just seems to move along in lockstep. So let's take a look at this. Go back over here on the chart. This is back in March of this year when price action was fairly flat up here. And you can see we had this sort of small topping area in place right here. And that topping area at that time, the advanced decline indicator, the one that's most reactive, was showing some downside, some divergence from the price itself. And, pretty soon after that divergence, prices begin to sell off. By the way, the sell and buys up here were those expert ratings, the first, if any of a series of ratings we've discussed in prior sessions, and I've just left them up there for illustration at the moment. Notice how what the advanced decline line was doing at the same time was kind of moving on in lockstep. And we saw this happening in a number of places along here. So over here, when price action was fairly flat, the advanced decline line was flat in moving in lockstep, whereas the AD indicator was kind of moving up just before this market moved to the upside. And this is happening again and again. Let me get rid of this trend line here a moment. So you notice up here with this topping area that happened in the sort of middle late May, look what's happening to the AD indicator. Again, you've got this sort of divergence in place from up here versus this, whereas the AD line is kind of staying flat. So you're not getting a lot out of that AD line. It does tend to keep going lockstep, but I like this AD indicator. You see this happen in more than one situation here. You know, sometimes it just moves along in lockstep with price action. But a classic example is, you know, up here when price action again was pretty much at the same high, slightly lower on this high here. Notice the AD indicator is already heading down before we had this move to the downside, whereas the AD line wasn't giving us a great deal of information. So I've sort of kind of like, okay, it's a contest between these two, and I think the AD indicator definitely seems to come out on top. So that's a good place to start from. I mean, it doesn't give us the whole picture, but it gives us some insight to topping and bottoming areas in the Dow Jones Industrial Average. So let's pop back into my PowerPoint here. So those were the first two that we looked at right there. Next one we're going to look at is the Advanced Decline Oscillator, also known as the McClellan Oscillator. So this one, again, we're still dealing with just advanced decliners. You know, in this case, it's the difference between a long-term and a short-term advanced decline moving average. You notice, like, you know, when you look at all of these here, it's a number of issues that are involved in here, just a number of declining and advancing issues. That's all we're dealing with in all three of these indicators. So again, in this one here, the McClellan Oscillator, or the Advanced Decline Oscillator, as we call it, basically is computed by subtracting the day's declines from the day's advances, and it's averaged on a short-term and a long-term basis. And we'll see what values we use for that in AIQ. And the oscillator is the difference between the two averages. It's a classic way of doing that measurement. So crossovers with this indicator from positive to negative, so there's a zero line, or vice versa, may signal the trend has changed in the index being tracked. Also, this was a point I didn't really come across before. When there's a move 100 points or more from negative to positive territory, it's called a breadth thrust, and it means a large number of stocks moved up after a bearish move. So we'll have a quick look and see if we can see any of those as well. So before I go any further, I won't go down to the next indicator. We'll go in and have a look at the McClellan Oscillator, the Advanced Decline Oscillator, on the price chart. So let's go back in here. We've got rid of the AD line because it isn't really telling us a great deal. You know, you can say there's some divergences. You know, price action reaches a new high, whereas the line doesn't. But it's far more obvious in the AD indicator. So we'll hold down the control key and get rid of the AD line. And I'm going to bring in now the AD oscillator, or the McClellan oscillator. So remember, we're using let me show you the averages that this is used over. Remember, the oscillator is the difference between the two averages of the difference between the advanced decliners. So within AIQ, the short term is set to 19, the long term is set to 39. And, you know, just double clicking on that indicator pops that up there. So I'm going to keep the AD indicator back up here, as we do like that. So let's look at the advanced decline oscillator. In this case, we're looking for movement across the zero line. It's a little harder at times to see because you get this area here, for example. When you get into sort of a consolidation or sideways pattern, pretty much like an MACD, you get this movement backwards and forwards. What I find more significant is when you get 1, 2, or 3 or 4 days of this oscillator staying in one territory, whether it's above the zero line or below the zero line, that's when things are starting into a trend. And you can see that quite clearly in this sell-off here back at the early part of April. Once things got down to like here, I mean, you're already 3 days in right here, for example. Once you're at this point here, or even 4 days in, you're pretty much in a trend and it stays down there and you could ride this all the way down. And, there's nothing that indicates that you would exit or use this as an exiting strategy. It's just while you're still in negative territory. Oops, I lost my place there. That's advanced decline oscillator. Once you're in that up there, click happy there. Once you're in negative territory and you see it like this, it stays in that territory while that trend is still in place. But the crossover is pretty good from these bulk areas in either negative or bearish territory or bullish territory here. You get the slip over here. That's a pretty good signal at that point. This area here, it's pretty good. It's negative until we get to here. This never really pops above. So we know these things are not perfect. Here we never get this buy signal for this move up. And it wasn't really much of a move until we got over to here. And it did pop over again, but it popped back down. So until you get a few days within a trend, I don't think this indicator works too well for us. Now, looking at it together with something, timing things like using the AD indicator, you would certainly say that, here you're in a trend, you could have ridden this up for several days. Once you got up to here, and the AD indicator itself is beginning to settle on down, this might be a time to exit. But again, we're not looking really we're looking for timing of the market here. When would you be in the market? When would you be in the market? And you'd be in the market in this area here. Right here, this down move was very, very powerful. And I thought, there might be something here that would indicate one of those 100-point moves that was in that part of the observation of how this indicated when you get a powerful bearish signal like that. And I look for it here. And of course, we're looking for this to change, the AD oscillator, change by 100 points. And but it's got to change. Remember, this is the thing. The 100-point or more from negative to positive, not the other way around. Now, I can find 100-point from positive to negative, but I could not find within the last sort of year or so any time when this indicator went from negative to positive as a strong move, indicating we might be moving to the upside, even though we've had some pretty powerful moves here and here. So, yeah, has some use, there's no doubt. Once we're in a trend, this is pretty good. AD oscillator. And of course, I've left it up there with the AD indicator for the moment. So slightly different way of looking at things with the oscillator. I like oscillators. Zero lines are pretty good. In absence of any other information, when you're in a situation like here, we change the date here so we can actually see what this would look like. When you're already in a trend here, after 2 or 3 days, you're going to stay in this move. You'd stay with the move while it stays above that zero line down here. You definitely stay in that move. Same applies here. This is the same sort of situation when you change the date back to here. So you can see, where you are in any particular moment on the market here. 3 days, this has been above the zero line here. Pretty good time to be in the market right there. Stays above there, so you're in a pretty good trend to the upside. Can't go too far wrong with that. So the McLaren oscillator or the AD oscillator, another fairly good indicator, along with the AD indicator. And of course, they indicate different things at different times, which is useful too. So the AD indicator is a little earlier indication of a possible change in direction, whereas the AD oscillator tends to do its crossover and get into positive territory once the trend is positive territory. It is once the trend is moving up or down, depending on which way the oscillator is. So that's AD line. We kind of I stick clear of that one. AD indicator looks nice. The AD oscillator definitely does have some, when you're in a trend. I mean, look at this back here. This thing is positive, positive, positive all throughout this time. No reason you wouldn't be in that trend and staying in that trend. Notice, by the way, back here, this is back at the end of last year, there's nothing to indicate here at that time that the AD indicator is doing a divergence down. So a great trend to be following up at that time. So that's three of the indicators that we're going to look at. We've got more to go. So remember, these are all based upon the advanced declines, the numbers advances and decliners. And that's all that's looking at on the New York Stock Exchange. And we're using that as in a comparison to what's going on in the Dow 30 chart. So the next indicator, which is the TRIN. Now, the TRIN, or also known as the ARMS index, here we're getting into a different area. So we're also not only looking at the advancing declining number of stocks, so how many stocks are going up versus down, but also their relative volume. So this one is one of those ratio indexes. So what you do, you divide the number of advancing stocks by the number of declining stocks. So, that's stuff we've seen in the AD line, those sorts of things. In this case, though, we're dividing the advances by the decliners, and then we divide the volume of the advances by the volume of the decliners. So that's the first step of the TRIN. So immediately we have two values right there. It doesn't matter what the number is. It's whatever the advances are divided by the declines gives us one number. The volume of the advances and the volume divided by the volume of the decliners gives us the second number. And it's the ratio of those two that gives us how this index works. I've got more on this right here. So, it's a ratio. So a TRIN value, and this is one of those flipped over indicators. So a TRIN values, which is, remember, the ratio between those two derived figures, below 1 indicates there are more advancing stocks and declining and more buying pressure. Conversely, a TRIN value above 1 suggests more selling pressure. So it's kind of the flips, it's almost can be like an overbought, oversold. When it's above 1, things could be about to head to the downside. When it's below 1, it's the reverse. So you can use it for potential reversals or confirmed trends. So if prices, but this is the other thing, the second thing, rather than just that above or below the 1 value, which is the ratio between the two, there's also the ability to look and see if prices are rising and the TRIN is rising. So you think, okay, it's rising, everything's rising. This suggests that the buying pressure could be falling off and it's signs of a reversal. So it's a little bit counterintuitive to how most of our indicators work. So if prices of the Dow Jones are rising and the TRIN is rising at the same time, that is a signal that things could be about to change in direction. And the inverse of that is true. If prices are falling on the Dow and the TRIN value is falling as well, so the indicator is falling, that could be a sign that we're reaching a potential bottom. So it's a little different, and it'll be obvious in the chart in a moment when we get to that. One final thing when I mentioned the value of 1. So this is the classic description of the TRIN and the way it works. AIQ has done a slight variation on this. We've sort of smoothed it out a little bit. The indicator still looks the same as it does in its classic mode, which we don't have in the system itself. But this is the way the AIQ Traders Index is computed a smooth average with a smoothing factor of 18%. But it doesn't change the way this indicator works. It just smooths out some of the whipsaws backwards and forwards. And the way we use it then, because of that smoothing factor, empirically it's been determined that 75 or lower is a market top and 120 or higher indicates a market bottom. So let me go and show you that in its AIQ version, and then I'll show you the basic version of TRIN, which I've put into an EDS file, so you can see which one of those works. So let's pop into charts again. This time we'll just go straight to the TRIN and take off the other indicators. So one thing I noticed here, and I'm just going to take this all the way over to the right for the moment. So we've got the current price chart, AIQ version of TRIN. Remember this slide here, 120 or higher market bottom, 75 or lower is a top. the first thing you notice with this is, okay, so 120, there's the 120 line, nice market bottom, very close to it here. This one here was pretty good too. This one here is pretty good too. Um, the thing you notice is the 70 is way down here. It never gets the market bottom. Now, this is something that's either a factor of the current internals of the market. So if I take this back a little way, it's very hard for it to get down to the 70 level. It very, very rarely happens. I have to go a long way back in time. I mean, but even back over here, where I'm looking at a chart that's, it's 81, right? And this is sort of as far as we go. So it's something to do with the internals of the market itself, that the smoothing factor that we've been using for years in here may not be as useful as it used to be. So that's something we may be looking at. And another reason why I have created the raw, what I call the raw, it's just the arms index in the classic sense. And I've done that in the Expert Design Studio. So before we go and look at that, the classic version of arms, I just wanted to illustrate that even with this 18% smooth version that we use, the interpretation where you have an advanced move to the upside and the TRIN is moving to the upside as well is a sign of weakness. So like this here, where you see the price action moving up here and the TRIN is moving up here, that's a sign of weakness. So when it's like this, price has moved here, but there's not much going on in the TRIN itself. Not a lot to indicate that there's weakness in the market itself. But you notice again here, there's price moves to the upside here quite strongly, but the TRIN itself kind of just kept going down until we got to this point here where it turned flat. But that didn't really give me much indication. I mean, it says, okay, so maybe this isn't going to last a huge amount of time. I mean, we are seeing this sort of divergence here, but it doesn't tell me anything because I want to see if this was a weak trend up, I wanted to see the trend moving in the same direction. So it's not a divergence we're looking for here. So what we're looking for is for this to be a weak move or for it to be a move that's about to be over, we look for the TRIN itself to be moving in a pattern in the same direction. So if I do this, let's decrease the spacing on this a moment, zoom in a little bit more. This is, for here, this was a very good one. It was easy enough to see this trend, going through here and this trend here that indicated that this was not going to last. It just showed us it was not going to last. There's also the same could be said for this move to the downside here. This was a very quick move, by the way. At the same time here, we are seeing in the first there's only 3 days, 4 days long, that the TRIN itself is also moving to the downside. So that's a sign that this move down is bottoming out or is going to bottom out. So that's the classic way of using the TRIN. So with the smoothed version here, you can see some of the action that goes on, but I wanted to show you the raw version, I guess you could call it, of the TRIN itself. And let me go and bring that up for you. Before we do that, give me a second here. So to that question from Doug, how did you get the buy-sell signals along the price line? I typed them on there myself, so just using a text tool. Let me just get back on topic here. Thanks for the question. The Expert Design Studio. So Expert Design Studio, of course, is our tool that allows us to design and build trading systems. And this is what I've been working on, a couple of days here. I took talking about that TRIN, which we did our 18% smoothed version, which has worked in the past. It doesn't seem to give us as much information when the bottom, the 70 lines off the screen. So price is the indicator itself never seems to get down there. So I went back and built the basic arms index, which is advancing issues divided by declining issues, value one, volume of the advancing volume of the advancing issues divided by declining volume gives me a value two. You divide the one by the other, and you pretty much got yourself a ratio. And so that ratio I put in here as a custom indicator. If you're not familiar with how we do that, I'll just show you real quick. We make that Expert Design Studio file and we save it, and then we go into our chart settings and we go to Indicator Library, EDS, which is Expert Design Studio Indicators. I add by going to find the file that I've created. That's the one we just saw briefly. Once I open that file, I can go ahead and create an indicator out of any of the defined indicators I put in there. In this case, I created the ARMS index itself, and I created it with a zero line. And so there it is down here. This is the classic ARMS index. And you can see why, the original plan had been to smooth this out, because it's a little rough looking. Here's the one line. When it's above there, it's basically, you're talking about the trend is supposed to be over. When it's down here, it's the reverse of that. So it's kind of, it's a little more difficult to interpret it, but you can see this type of situation where it talks about TRIN, the same thing we saw on the AIQ version, where the slope is up on the ARMS index and the slope is up on the price action. It means the trend is not going to last very long. Same with the downside here. So you can see it works both ways, but this gives me a little bit more information on the bearish side of things. I mean, here, you've got the trend is going up here. The index is going in the opposite direction. Doesn't tell me anything. Doesn't tell me anything at all. Same here while this down move is happening. This is fairly flat or going in the opposite direction. So that trend of the indicator doesn't tell me a great deal. But in the circumstances where we do get the two moving in sync, it is the sign that there is a change of direction about to come. So that's that's a standard ARMS index, a little less easy to interpret, except for the direction when it's in sync with a trend to the upside or the downside. So let's go back into the PowerPoint here. I'll make this PowerPoint and that Expert Design Studio available for you when we post the recording out to everybody who registered, and you'll get to see, and there'll be instructions about how you could do this too, because there's another indicator I've created, which we'll come to in a moment. So still like that 80 indicator, the TRIN does have some value too. This is not an AIQ. This is called Zweig breadth thrust, developed by Martin Zweig, and he was famous for actually predicting some of the 1987 crash. So the calculation of the indicator is pretty interesting. It involves basic dividing advancing issues by the advancing plus declining issues and multiplying by 100. And we get a 70-40 level. A level above 70 is bullish, while a reading below 40 is bearish. And again, this is a divergence between price and breadth thrust readings, where the prices are making new highs, but breadth thrust readings are not. It could indicate that prices could reverse, and of course, vice versa. So this particular indicator, so we're going to be looking for that sort of divergence, price new high. This is not making a new high. And this indicator, which is, again, relatively easy to program within here. I just put some comments up here. There's also another measurement, that reading above 70 or 0.70 and 0.40 if you don't do the multiply by 100. A reading above 70, a bullish market trend. The reading below 40 is bearish market trend. So we've got two ways to use this. We've got whether in a trend up or a trend down, and we're also looking for that inconsistency with the price versus the value of the indicator. If price is at a new high, but the indicator is not. And the code is relatively simple. If those of you who are interested in it, it's right in there. These are all part of the system here, these advanced issues, decline issues, etc. So let me pop in the chart so we can see what that looks like. Here's the Zweig breadth indicator. Again, we've got another one. Because it's simplistic in the way it's calculated, it moves around relatively rapidly. Notice the two levels, the 70 level and the 40 level, that we put the lines in there. But the big thing here again is to look for prices making a new high, whereas you're not seeing that on the indicator itself. And this typically happened here. This was Right here, this was the biggest moment really when prices were a new high right here. The indicator definitely wasn't. In fact, it was, moving away as prices were moving up. We don't care when it's moving up here. What we care about is if it reaches the new recent high right here, is the indicator showing the same thing? And it wasn't. So that's a pretty good diverging signal right there. Remember, when it's above 70, we're in a trend. So it's in between here, it's neutral. When it's below 40, it's bearish. So at this point here, we were in a bullish trend. Then it's in a neutral territory. We get to a new recent high, but it's not confirmed by this indicator. And that gives them a sort of insight that things aren't going to last. So when we get down to the sell-off on this Dow Jones in May here, we get down to this low point here. I mean, this is setting a new low. At this point here, there's a new low in the indicator. So there's nothing here. There's no indication that we're getting that divergence there. So we know these things don't work 100% of the time. But we do look for recent highs to see if this is happening again. So here's a recent high right here. Let's put that right on there. Look where the indicator is. I mean, it's firmly down in bearish territory. Sorry, that's one over. No, that is the new high right there. So look at that. I mean, this is July the 18th, and it was in trend to the upside. Here, it's popped right down into bearish, and we're at a new high. So that's a real big divergence. That's a really interesting signal right there. And you see this happening, on frequently on the new highs, not so much on a recent low. So like here, this low here, there is nothing here that says, oh, okay, this low, this is, the indicator should be up here. Maybe here, if it had happened, you'd be going, oh, wow, that's interesting. The indicator's made a new low. Sorry, the price has made a new low, but the indicator is diverging from it. So, but works pretty good at the tops there. I mean, this was a more recent new high, like a 10, 12-day high. But again, the indicator's firmly down in the below 40 area. So interesting indicator, that Zweig breadth. I think we'll have to look at that in some more depth. But that's one is in, I programmed that in there with the arms index in its raw form as well, so that you can check that out. So that's I like that. So I like the AD indicator. I particularly like this slide breadth as well. The that on the TRIN's okay, but I think it needs some tweaking, to be honest. The arms index is again pretty reasonable when you see these sorts of trends in place like that. But again, when the arms index is following the market's direction, remember that's the sign that it's going to change. So that's a counterintuitive to our regular indicators. So those I like. Let's pop back. I've still got more to go here. We got one more indicator to look at tonight, and that's the up-down volume oscillator. So this one is the difference between two moving averages, a short and long-term average, each being a moving average of the net difference between up volume and down volume. Goodness, that's a mouthful. So, and it's an oscillator of the strength or weakness of market volume. So this, unlike our AD line, an AD indicator, an AD oscillator, where we're dealing with just the number of issues moving up or down, here we've gone straight into the volume. And what it's looking at here is nothing but the volume and taking averages of volume to look for strengths and weaknesses in the market. So again, an oscillator, we've got a zero line. Zero line is our demarcation between bullish and bearish. When the up-down volume oscillator is greater than zero, or when it crosses over from negative to positive, it's shown that net volume is up and the strength of short-term volume exceeds long-term volume. So this is the key thing because it's using two moving averages. It's almost, again, it's like an MACD of volume in here. So you're looking here, that short-term volume is increasing. So it indicates some strength and supports a market rally because, you're looking at the up volume versus the down volume. So if the average of the up volume short-term is increasing, that means there's money moving into stocks that are moving up. Makes perfect sense. The opposite is true when it drops below zero. showing increasing down volume and supports a market decline. So this is an indicator that is built into AIQ. So we have that in here. And let's just go back into my chart here. And it's called up-down oscillator. I don't know why we didn't put the volume, probably because it's got too many words to fit in the space in there. So again, oscillator crossover of the zero line is our key thing here. Again, it's not dissimilar to what we see in that advanced decline oscillator, because if I put the two together, just so you can see this, so not dissimilar. This definitely does have some differences. But again, they use the similar type of calculation because they're looking at a shorter term and a longer term average, except one is looking at the shorter and the long term averages of the advancing declining issues. The other one is looking at the advancing decline issues volume. So both of them together kind of give us an overall picture of a possibility of a change in the market. So when you're in a situation like this with a crossover to the upside, in both of these indicators, it's a pretty bullish indication. And the same applies when we get to the downside. So this move to the downside here, both times when both of these are strongly down as they are here, it's a sign that things are not looking good. The buy signal is the same as the crossover to the upside. In this case, we're looking at the up-down oscillator. Let's have a look at its value for right here. So the up-down oscillator was still negative there. It's still negative there. It only goes positive right there. So it only goes in when the trend really, even though it's using a short-term moving average of volume is the key factor there, it's only beginning to pick up on the trend after a few days of the trend being in place. And this is true over here as well. The trend has been in place here, although it's not it's pretty flat. It's picking up on it as soon as that's gone into positive territory. So that together with both of these indicators in the positive territory, so we're looking at advanced decline issues, we're looking at advanced decline volumes, using different smoothing techniques, and oscillator is the difference between the two averages. Both of them together in positive territory, like in here, gives you a strong indication that you are in a pretty good trend to the upside. So one last thing in here, just wanted to, so we've looked at the arms index earlier. I just wanted to show you this is the advanced decline raw. That's the one thing that I just wanted to put up here because some people actually use this in determining just for a snapshot if there's something unusual going out there in the marketplace. And this one is, let me just show you this in Expert Design Studio here. I just created a raw advanced decline, purely advancing issues minus declining issues each day. And it's just so you can see that, so you can see what's going on one day to another. When you get clusters of advances versus decliners is in very positive territory here, that's a sign of a very strong trend in place to the upside. But you notice here, what happened here. Look at this. The number of advancing issues versus declining issues moved into negative territory just as we reached that, just the day before we reached that high in the market, which was right here. By the time we got to that high in the market, right there, look at the number of advances minus decliners. That's a really sure indication that this thing's run out of steam. Even though it reached a new high on that day, that's again the Dow Jones, the internals are saying, hey, this is rolling over. But it doesn't always give us that sort of indication because look, when you look over here at this particular point, the market here has pulled back somewhat. We have decliners here pretty much similar to they were back over here at that top. But they switch around very, very quickly. So once we get to this stage here, this is still a negative market day there. The right here, it's still a negative to the downside day, but there's a switch around again. The AD is switched around very, very rapidly to the upside. So that's kind of an indication of when there's an exhaustion of this move to the downside when that happens. Same applies over here. I mean, with obviously very, very, very negative, moving down, decliners are outweighing the advances, and bang, you get this. As soon as this comes into play right here, that day there, and it was kind of an inside day for the other candle there. But the advances really outdid the decliners by a huge amount. So it's kind of a sign there could be a switch around. And you do see that happening in most of these moves. Look at these move down here, down, 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 down. And then we've got this day right here. I mean, it's another big bar down. What, there's nothing to indicate this isn't going to continue down. It's all been pretty nasty to the downside there. But lo and behold, the advances outdid decliners quite a bit right on that day. So this indicator has some pretty good value as well. So I kind of like, this is useful. Having this indicator, I like the Zweig breadth. And again, these are things you look at on a regular basis each day if you're doing your analysis. As I said, I like the AD oscillator, which is a good indicator as well. And the other one that's good is the AD indicator. So these are the ones we're looking at. So again, we're looking for divergences on some of these. We're looking for in that TRIN indicator, if you go in for that one, or if you go in for my ARMS index, which is the raw version of the TRIN, we look for the indicator to be moving in the same direction as the trend to indicate that the move may be over. So that's there are a couple of other indicators out that I explored that really didn't add much value into analysis. I think you could get overcomplicated by looking at too many indicators. Guess what we didn't look at, right? This indicator here, high/low. And this indicator sometimes you get some really weird readings on this. I mean, look at this chart here, right? I mean, what do I see here? When you look at the high and low, you get a divergence like this one here. I mean, look where the high-low indicator is, right? I mean, look where the price action is. Look where the indicator is. It was way down there. It is, the new high versus new low is definitely not following this price action. This price action's been going up, and this number of new highs versus new lows has been declining. So, new highs and new lows are, it's a little iffy area in my mind because, obviously stocks make new 52-week high and 52-week lows, throughout the year. How much of a broad indication is it? It could be serious. I mean, it could be the more you see this diverge from the price action, the more likely it is it's running out of steam again. It could be that. But you also see situations, this is a good indication here when prices move back up almost to the same high. Look what happened. The new high and new low was going even higher. There was no indication there that this was going to happen based upon this. There's no overbought or oversold value on new high or new low, other than the fact that when it reaches a peak, usually you can see the peak because then it sells off afterwards. And it's almost self-fulfilling. So I find it a little difficult to use this as a tool for making any decisions. So, but it is in there. It's widely watched as well. So just a recap on those indicators, and we'll wrap up for tonight. The indicators in here. First one, as I said, when the AD line, as we saw, that one, the advanced decline line seems just to follow along with price action. Doesn't give us a lot of information. This one does. We got the advanced decline indicator, and the direction of this was kind of interesting. When we saw the sort of several times prices reach a new high, this thing was diverging down. So that's a good signal on that one. The oscillator itself, some of that was working over their crossovers. Again, when it's crossed over for more than 2 or 3 days, we know we're in a trend. But the 100-point thing, just can't seem to find that at the moment. So that's one of those interpretations we'll have to look at. TRIN, which is the ARMS index. ARMS index, remember, we look for price action. If it's going up and the TRIN's going in the same direction, price action's going down, TRIN in the same direction, that could be a sign that this particular market is going to change direction. And we also get, we get an indication from this when it's in bearish or bullish territory, based upon, at least in the AIQ version, the 120 and 75 level. But of course, as we saw, the 75 level, I know, seems to get down there at the moment, although we saw it nicely at the 75, at the 120 level. we saw that was a very good indication of a market bottom when it did reach that level. Yeah, the Zweig breadth thrust, you know, this one was divergence looked pretty good on that one, and the up down volume oscillator. We used that together with that AD oscillator. So we had both oscillators because they're similar in their calculation. They use the short term and longer term average, and it's the difference. The one is the volumes of the advanced decliners, the other one is the number of issues. So those together, both of those doing the same thing, although they're somewhat similar, gives us a good indication of what might be coming up in the market. And let's go back into here. And that's pretty much it for tonight. Well, 40, look at that, 45 minutes on the dot. Any questions, pop them in chat. I'll have this recording rendered probably tomorrow, and it'll email to the 50 or so registered. And everybody, those who turn up, turn up. Those who don't, watch the recording. And I think that's just fine. We'll have another session next month, and I'll be working on some other indicators. Any questions to say, pop them in chat there, and I will attempt to answer them for you. Yes, Wilfred. Yeah, it's an interesting area, isn't it? Those indicators. I mean, I really hadn't done a lot of in-depth look at them for a while, and once I started delving into them, it just suddenly the light bulb went on, and I was like, oh yeah, this is why AD line, because it's like AD line, AD oscillator, AD indicator. It just seems like too many ADs in there. But when you get down to it, it's that AD indicator or the AD oscillator. Both of those are pretty good. The AD line, it just doesn't do it. So, and going back to that, the raw advanced decline raw number, that was interesting too. And again, that's not in the system as a canned indicator, so it is one of the three that I added as a custom indicator. So I'll have instructions with the recording, and we'll get all that out to you. Yep. Any more questions? Pop them in chat. I'll endeavor to answer them for you. Well, great. Thanks, everybody. Thanks for giving me your time this evening. Hope you have a great rest of your day, and we'll be back on the air in a few weeks. Thanks again.